I'm going to jump through the presentation here. I'm gonna dance around it a bit today. I think a lot of people here probably know our story. You know that we say a lot of forward-looking things that we have to put this disclaimer on the beginning of the presentation for. But for those who don't know about Ely, we're a junior gold royalty company. We've been doing this for about 5 years now. We've built our portfolio pretty much organically. In other words, we have not done any large transactions with companies where we bought or spun out. We're spun out by a royalty portfolio of any kind. So my partner Jerry Bachman and I have pretty much built this, and we have a two-pronged approach there. But we've stayed very focused, mostly in Nevada, where about 80% of our assets are. We also have a secondary focus in Canada, especially Quebec and Ontario, where we've identified some real quality assets. And we've done pretty well as far as our performance of our stock over the last couple of years. But we remain very undervalued, and we think that's something that we kind of base our story around. The royalty market, I think most of you are aware of the royalty story and all the positive things of why the royalty model is an excellent business model. It certainly has become more competitive in the last 12 to 18 months as more royalty companies have kind of emerged, and so it's a more competitive environment. We're not seeing a lot of new gold mines being built, and while there's been a few opportunities, even at these higher gold prices, you're not seeing the construction of new mines. So that's again, that's a negative for the royalty companies and for the junior companies. It means that we're seeing more competition from the larger royalty companies coming down to swim in the baby pool, if you will. But it's all the more important why I think when you look at a junior royalty company now and look at the underlying assets and how they're being developed and who they're being developed by, it's where Ely again just really stands out as a extremely undervalued portfolio. As this business has become more competitive, we have kind of stuck to our knitting in a few areas. We think this jurisdiction play is, and we're seeing it now. We've been preaching this for the last few years about Nevada, about Canada, and not going outside of our backyard there. And it's really starting to play out. You're seeing some nationalization in Eastern Europe of some gold assets. You're seeing some of the traditional mining countries like Chile and Peru instituting or threatening to institute some huge taxation and or nationalization. So again, we really like our jurisdiction focus. In this space, we have felt like not only on our jurisdiction, but also on our counterparties, we have such good assets in such good jurisdiction with such good operators that we're unwilling to pay up and dilute those assets by buying assets as they're trading in this competitive marketplace. So consequently, you've probably seen us doing less deals in the last 12 months than we traditionally have. But on the other hand, the case we want to make today is that the assets we do have, while we can't always be right on top of. They're controlled by our partners, of course, that are the operators of the assets, and we can't exactly control their news flow. But we are seeing our assets being developed by these companies, and that's something that we think our patience will pay off, not only because we're not diluting our assets by buying higher priced assets in lower jurisdictions, or but just not as quality of assets and overpaying for them. But also, our assets are being developed as we're sitting here, being conservative and not being as active. Now, we still operate a large strategic Nevada property portfolio. So on the royalty generation side, we're seeing still strong demand for properties for exploration companies in our royalty generation program. And not only that, but we're also seeing some of our partners there, like BlackRock Silver and Contact Gold, really showing some strong results on the exploration and developing new projects for us. And keep in mind that those in that portfolio, we are not purchasing those exploration royalties. We're actually getting paid to generate those. So you see some recent deals last year by our competitor Metala, this year by our competitor Sandstorm, who are out buying exploration royalty portfolios in Nevada, and and these are they've paid millions of dollars for royalties that we would actually get paid millions of dollars to generate. So we think we have the superior business model there again on the longer term. So I'm going to again jump through here a bit. The results that when this is starting to be a bit passe, what we accomplished in 2020, and we certainly, while not seeing that kind of activity in 2021, still on track to reach our goals that we that we've instituted. So we think that just the corporate overview, not much has changed here. About 200 million shares outstanding, fully diluted, with most of our warrants and options in the money. So we like to look at the market cap based on a fully diluted basis. We still have access to a line of credit for about $6 million that's not drawn, and about 7 million, 8 million with investments in total working capital. So while our stock with the rest of the royalty group has pulled back a bit here, we still think we're in a very strong position going forward, and still in we think that that the stock has turned the corner in here with a lot of the rest of the market. I'll touch on this slide quickly again. The key to this is, I think on both ends of this slide is the business model, where we're not only purchasing royalties but generating royalties through our property acquisition and sale program. Keeping in mind that most of those properties we put together through our database and our knowledge, especially Jerry's knowledge in the Nevada market for putting property packages together that that majors, mid-tiers, and junior companies are really attracted to. And then at the other end, looking at our key assets and our current royalties, that what we call that clear path to production. So of our 12 key assets, 9 are currently at producing mines. So our royalties are not looking for a mine to be built there. The mine's already built, just looking for our assets to come into the production scenario. And all of our assets, of our 12 key assets, are with some of the industry's best operators, and with only an exception, or one exception really, are all fully funded to production. So looking at those again, I just go down the list here, and what I want to do on this slide today is just point out some of the growth and the value that's being added to these properties as we speak, really, and some things, like I said, that we can't really always comment on from from the standpoint of putting out news flow. We're kind of dependent on our partners for that. But at Isabella Pearl, this Fortitude Gold is now the spinoff of the Nevada spinoff from Gold Resources. They're getting very aggressive at Isabella, continuing to mine. We have that small 3/8, it's a 0.375 royalty. But important to note that the expansion at Isabella Pearl, which is being promoted by Fortitude now at what they call the Scarlet target, which they believe is, they have discovered the extension of the Isabella Pearl deposit. So they're expanding the permitting and the leach pad space there for more ore, and from the Scarlet area. And that is the first target north and west of Isabella Pearl. This is all property where we have an additional royalty of 2.5%. And so as that comes into production, we'll be being paid on 2 royalties there. And Scarlet's only the first of many targets going on trend to the northwest of Isabella Pearl that's inclusive of that 2.5% royalty. At Jarrett Canyon, where we have 2 royalties, as many of you probably know, First Majestic Silver came in and bought that from Eric Sprott. They paid about $500 million for this mine, and we think it's still one of the best assets in Nevada. It's 119 square miles of some of the best unexplored lower plate rocks in Nevada. It is a mine that is just perfect for First Majestic, with their expertise in not only underground mining but in metallurgy to increase recoveries at the mill. The mill there is the only mill left outside of the Nevada Gold Mines joint venture with Barrick and Newmont that can handle refractory ore. And we have a lot of respect for First Majestic and Keith Neumeyer. And this is an asset that's currently producing at about half its capacity at the mill. And of course, we have 2 royalties there. One is a per ton royalty on everything that goes through the mill, and then the other is a 0.5% NSR. And we think in the hands of First Majestic, this asset is going to come back in, into its heyday. And we don't believe that First Majestic, who stepped out of their comfort zone for sure on this, buying a gold asset and an asset in Nevada, outside of where all their other assets are in Mexico. And again, with the respect we have for Keith and his group, we think they also recognize the value. They are paying $500 million for this. They didn't do that for to have this mine produce at 50% of capacity. So we think there's just tremendous upside, and actually our numbers here on this slide reflect that. And Just going down the list here, Rawhide has been a producing asset. It's now coming into production for us on our claims and our net profit interest. Marigold, operated by SSR Mining, they'll be producing from our claims next year. Plus, we have a couple of other royalties there at Trenton Canyon that where they're doing some seeing some outstanding exploration. At Lincoln Hill with Coeur Mining, they're expanding the Rochester mine with a 300 million ton leach pad, and that Lincoln Hill ore will be mined and placed on that pad, we think, starting in 2023. The Gold Rock asset being developed by Fiore Gold, a small but very sharp guys. Of course, our Ren, where we have not only a leased property there at Ren with the NSR, but also an NPI on Ren. And anything you see coming out of Barrick these days, they'll be talking about Ren is one of their top 3 development projects in Nevada. Bar none. It's the underground extension to the Gold Strike mine, which has produced over 50 million ounces. I mean, if you talk about the 90210 area code, this is it in mining. Then beyond that, we have the Hog Ranch asset being developed, the railroad being developed by Gold Standard. And then in our key assets, the one asset up in Quebec is, of course, Fenelon with Wallbridge Mining, who continues to put out extraordinary drill results and should have a new resource coming out on Fenelon later this year with some strong plans for how they intend to put that into production. So, I mean, we put our key assets up against just about anybody in the business as far as the development, and of course, again, very focused in Nevada, and with that secondary focus in Canada. So, we're looking at very good, sales. We met our sales goals for last year. We're on track to reach our sales goals for this year. Costs are we've been really focusing on keeping our costs down and getting, moving towards profitability, and just an outstanding growth prospects for our royalty portfolio as it comes on stream. And I might note that Ren is not, and Fenelon are not even included in these numbers here. And we think by 2025 they certainly will be. But talking about the rest of the portfolio, we covered those 12 key assets. On the development side, for us, how we break down our asset portfolios, those key assets, those are either in production or assets we think will be in production by 2025 with the top industry operators. The development assets are by definition, they're located at or near producing mines. So again, our properties don't necessarily have to become big enough to warrant building a mine. In most cases, the mine is already there, or the projects are part of a deposit that's other deposits, surrounding deposits where it's already gotten big enough to warrant building a mine. So that that would include a lot of resources we have with Fortitude Mining, McEwen Mining, at the Côté mine up in Canada. So some very interesting assets which are being developed again at or around producing mines, or along with other assets to become producing mines. And then the exploration assets, these are for almost all are either royalties that we hold or properties that are being optioned in our sale program. 12 are currently being drilled by some of the top junior exploration companies, and again, these are royalties and options, sale options, where we're getting paid to generate the royalties, and of course we always keep a portfolio of properties for sale. So they the value equation here for Ely Gold, if you look at us compared to, I put this slide together. It's, the royalties being based on two metric. One is the net asset value per share, then the price to net asset value, the multiple, if you will, of the net asset value per share, and also on enterprise value to EBITDA. And it's fairly consistent. I mean, Franco-Nevada leads the way. The stock has obviously been very strong, but they have the benefit of a perfect storm here of being involved in oil as well as gold, and a lot of copper assets as well. So Franco's certainly the standout here on a performance basis, and it's reflected in their multiples. But when you get below them, you start to see that the Royal Gold and Wheaton Precious Metals at 14 to 17, all the way down to Sandstorm, anywhere from 12 to 17 times EBITDA, and around 1.75 to 2 and change times on a price to NAV basis. Cisco being still, we feel, a little undervalued in that. In the junior royalty space, we don't pull a lot of samples here because there's just not a lot of research done to have a consensus on the NAV and EBITDA. So you'll see the NAs in here as they reflect, but on a price to NAV, I mean, Mavericks Metals trading at about 1.6 times, Metalla at 2.3, even Nomad Royalty at 1.34, and Ely Gold Royalties at 0.84. And we just don't feel like we are that far behind on the EBITDA basis, but on when you look at the quality of our portfolio, who our key assets, the operators are, where they are as far as jurisdiction, and the amount of work that's going into our projects, we think that at 0.84 times NAV, we're just a very undervalued situation here, and that undervalued price to NAV is something that we think investors really need to take a look at here. Drill down on our resources, who they're with, where they are, and look at us compared to the other junior royalty companies and say this really is an undervalued situation. I have just the one slide here with Royal Gold as far as what has happened here since the markets turned this spring for both gold and gold equities. Certainly the leaders like Royal Gold, I took Franco off of here because it was kind of into the stratosphere, and it's more based on the oil situation. But if I put Barrick Gold or some of the major producers like that, I think the charts would look similar. So we've seen because of liquidity drying up and just a lack of real interest in the market, we've seen our stock kind of pull back from that 200-day moving average. But we think for those that are technically oriented, we still think we're in very good shape here, setting up for future gains. So we started out this year with a few goals, and while it's been more market or driven, that the listing on the American Stock Exchange, and we have filed our AIF. We have a shelf prospectus actually ready to go. But we just don't feel this is the kind of market and we quite frankly don't have, we've got plenty of cash and liquidity with the LOI, so we don't think this is the right environment to go filing a big shelf prospectus and doing a rollback for the listing on the NYSE. We still have that goal set for Q2 and Q3, but we think that we need to see more market activity, more market interest in the gold equities in general, and in the gold royalties, junior gold royalties specifically, before we think doing some kind of corporate transaction dealing with our stock and rollbacks and listing and GDXJ or other gold index inclusions is really the best use of shareholder funds, first of our working capital, but also the right move for shareholders. I think we need to time that. We're certainly ready with that goal, but we're looking more towards right now, waiting for the market to guide us and tell us that there's a big interest in the stock, and there's an interest in it, and it's worthwhile to do a listing and do a rollback in the stock, and things that are we think. We just don't think it's the right thing to do in this quiet market that we're in today. We are working on still on more brokerage coverage, and and then adding key assets to the portfolio. Our goal was to add 4 this year. We've already added 2 on the development assets. We've announced 1. We have 2 more that are in the works. We have listed or announced 2 sale properties, and we have 2 or 3 more that are in the works there. So we're right on track to meet our business goals. But I want to make clear to everybody, because I know that that's some of the questions everybody has about this rollback, and the listing and that is a big move, and we've heard from shareholders positively and negatively on that. So at this point, we're really waiting for a signal from the market as far as the liquidity and the interest that makes sense to move up in that listing. So, that's really it as far as the presentation. We think, we still think we're in the right spot in that junior royalty space, albeit in a more competitive environment. We still think we have the strong growth model with the royalty generation as well as the royalty purchase. Certainly in Nevada, we still feel like we have a leg up on the competition as far as identifying the potential acquisitions and getting them closed. We are very happy with our current portfolio, and and especially most specifically our key assets, because they are all moving very quickly towards production. They're all in the safest jurisdictions in the world right now. We're very concerned for some of our, as we look at the idea of going out expanding our jurisdictional focus. I mean, we look around the world and we see things going on in Chile and Peru and Eastern Europe and Mexico, and we just aren't. We just think there's tremendous risk in these developing and nations in what's becoming a worldwide phenomenon, and arguably kind of led at this point by the U.S. Of wanting to tax assets anywhere that and individuals raise taxes anywhere they can. So I will comment on the recent Nevada changes, and this again is something that when you look at Chile talking about and Peru talking about 75% mining taxes, we did see a modest 1% rise in the in what would be the royalty tax from 3 to 4% for our Nevada assets, and quite that 1% is something obviously we can live with very easily. So again, we finally are sitting here with a very quality portfolio. We offer, we think, an undervalued situation with some of the best leverage to the gold price in the industry. So with that, I'm going to close it off. I'm told I just got notice. I think, Mark, you can jump back on here, but it looks like we're out of time and not going to be able to do Q&A today.
Just looking at the clock, Trey, you're absolutely right. But I do want to say on behalf of everyone at the conference, it's always great to hear your voice in the sector, and to thank you deeply for being part of the VID conference. Very much appreciate the presentation and the perspective. And well, thank you for your time, and I'll be watching the company very closely. Thanks again.
Great. Thanks, Mark.